PayPal reported earnings last week and the stock collapsed 15%. Shares are down 80% since its all-time high, which means the company has lost more than $270 billion in value. Right now, the company has a market cap of $71 billion. Adjust for cash, investments and debt, and the enterprise value is $67 billion. Revenue over the last 12 months is $28.6 billion, net income is $4.1 billion, and free cash flow is $3.6 billion. So PayPal is currently valued at 2.3 times revenue, 17 times earnings, and under 19 times free cash flow. That looks cheap. In fact, PayPal hasn't been this cheap since 2017, and in 2017 the business was producing significantly less. For example, revenue in 2017 was only $13 billion versus $28 billion today, and net income in 2017 was only $1.8 billion versus over $4 billion today. So what's going on? The key issue is that PayPal is experiencing slowing growth. Revenue growth has slowed from 20% in 2017 to just 8% over the last 12 months, and investors are concerned about a large number of competitive threats. Apple Pay is rapidly increasing its share of digital payments, and there are other big rivals such as Google Pay, Block, Shop, Zelle, Wise, and FedNow. Although PayPal posted a 7% increase in revenue in the latest quarter, its number of active accounts fell for the second quarter in a row to 431 million. Gross margins have also fallen to 41%, and the company's take rate, which is the amount of money it earns per transaction, has fallen to 1.7%. But there are some positives. Activist hedge fund Elliott Management is helping the company to reduce costs and return cash to shareholders. The company expects to repurchase $5 billion worth of stock this year, which could boost earnings per share by up to 20%. Venmo is still widely used as an app, and PayPal's unbranded payment system Braintree drives the back end for some large tech companies like Airbnb and Dropbox. This segment is lower margin, but it's showing solid growth in the region of 30%. More importantly, PayPal has suffered from a general slowdown in e-commerce activity after the pandemic. When that activity picks up, revenues should also rebound. But again, it won't be easy. PayPal's Braintree segment also faces fierce competition from the likes of Stripe and Adyen. And with so many businesses wanting to enter payments, perhaps the most logical conclusion is a gradual decline in transaction fees across the board. Let's assume a simplistic scenario where PayPal can grow its earnings 10% per year for the next 10 years, then trade at a 25 times multiple. In that scenario, the company would be worth around $266 billion in 10 years' time. That works out to an investment return of 13.6% a year, which seems fairly reasonable. Overall, there are clear pressures facing PayPal, but the tailwinds for online payments are also pretty strong, and that should keep the company on the path to growth. At less than 18 times earnings, I rate the stock a cautious buy, but these are my personal opinions, not financial advice, and I hold no position in the stock. For more detailed investing ideas, make sure to visit our website, overlookedalpha.com.